Let's assume you paid for your office rent for 2 years, 2019 and 2020. Now, by the end of 2019, we expect to report the activities of 2019. For office rent, we expect to charge that of 2019. Say, for instance, each year is 1 million. It means we have paid 2 million. But we cannot charge 2 million as the office rent for 2019. Rather, we will charge 1 million for office rent for 2019. So what happens to the other 1 million that is for 2020? It means that we have paid an amount of money for an expense that we have not yet incurred. Hence, we will say that we have paid for rent in advance. Now, in reporting activities of a business, certain items will appear that are not incurred or earned in a particular reporting period. So what is expected for us to do is to do what we call adjustments to the accounts. Now, in this class, we're going to be looking at one of the adjustments, and that adjustment is the adjustment for prepayments in final account. Now, remember that the prepayment is an adjustment to the final account, which includes the trading profit and loss account, or the comprehensive income statement, and the balance sheet, which is called the statement of financial position. Now, when you have prepayment, what do we actually mean? Prepayment simply means payment in advance, or we can say prepayment means what? Advances. Now, what I am trying to say is, for instance, you have not incurred an expense, or you have not earned an income, but you have paid for the expense, or you have received the cash. So what I'm trying to say is that it is possible for you not to have incurred an expense, but what? Pay for it. For instance, paying for the rent of 2020 in 2019. It means that you have paid for 2020 rent in advance. So that is referred to as what? As prepayment or prepaid expenses. It is also possible for you to receive an income that you have not yet earned. Let's say, for instance, you own a property that you have rented out, or you let it out to tenants. Now, if your tenant is paying you for a year that is not yet due, as an income to you, we will say you have been what? Prepaid. You have earned an amount of money that you are not, you've received an amount of money that you have not yet earned. So we call that prepaid income. So in a simple form, prepayment can take either the form of expense, which is prepaid expense, or the form of what? Income, which is prepaid income. Now, prepaid expenses. What I am trying to say here is that the expense has not been incurred, but payment has been made. We are still taking rent as an example. Let's say that we made payment for rent to cover 12 months. That's January to December of a particular year. Now, if we are to report half year, which is June, the remaining half of the year will be treated as what? Payment in advance, since payment has been made for it, but the benefit not yet enjoyed. So what I'm saying is, any expense that payment has been made for, but the benefit has not been enjoyed, is called prepaid expenses. Now, we can have prepaid expenses at the beginning of the year or the end of the previous year. Now, in accounting, the end of a particular year marks the beginning of the next year. So, if you are giving the end of a previous year, technically you are being given the opening balance of the next year. So I can express a balance for 2019 as balance as at 31st December 2018. So understand that the balance at the end of a previous year is the same thing as the balance at the beginning of the next year. So when we have prepaid expense at the beginning of an accounting year or at the end of a previous year, the adjustment is by adding the value to the charges for the current year. What I'm saying is, if for instance you paid for insurance in the current year amounting to 125,000, and then you are being told that there's a prepaid insurance reported in the previous year to be 5,000. What is expected is that you should adjust what for the prepayment in the previous year in the what amount paid in the current year. So in adjusting that, I have told you that prepaid expense at the beginning of the year is added to the value charge for the current year. So in our instance, we have paid 125,000 for the current year, and they are not telling us that there was a reported prepaid insurance in the previous year to be 5,000. Since the rule is to add prepayment at the beginning of the year or the previous year to the amount of the current year, it means that we're going to report what? 130,000 in the income statement or in the profit and loss account, assuming that there's no what? Prepaid insurance at the end of the current year. Now, this is what I'm saying. This is the illustration. For instance, a payment for insurance in the current year is 125,000. Let's take the current year to be 2018. And then the prepaid insurance reported in the previous year to be 5,000. Let's take the previous to be 2017. So the end of 2017 is the beginning of 2018. So prepaid insurance in 2017 is the beginning in 2018. So the prepaid insurance at the beginning of the period is 5,000, while the amount paid for insurance is 125,000. And I've told you that prepaid expense at the beginning of the year will be added to the amount charged or paid for the year. So it means that in this description, you can see here now, look, this is the insurance account. Okay, you can see your debit and your credit. Are you there? Now we have prepaid insurance at the beginning of the year, 5,000. We have cash paid for insurance, 125,000. When you add 125,000 to 5,000, you have 130,000. That is what we are transferring to what? Profit and loss account. So you can see that here we have profit and loss account extract for the year. This is because we don't have complete information. We're just trying to use this as an example. So this is an extract. So you can see total expense here. Remember, our profit and loss is to show the net profit, which is run between gross income and total expense. And insurance is part of the total expense. So that I'm putting that here. So we have insurance with 130,000. So this 130,000 is what we are charging as insurance for the year 2018, after adjusting for the prepaid insurance as at the beginning of 2018, which is same as the end of 2017. I'll say it again. Prepaid expense at the beginning of the year is added to what? To the expense item for the what? Year. Now, we have looked at prepaid expense at the beginning of the year. Now, how do we treat prepaid expense at the end of a particular year? Now, prepaid expense at the end of the current year is adjusted by what? Subtracting the value from the current year charges. Remember, I told you, I said at the beginning, prepaid expense at the beginning is what? Added. For prepaid expense at the end of a particular year that you're reporting is what? Deducted from the current year charge. Now, that value of what? Prepaid expense that is deducted is now treated as what? A current asset in the statement of financial position of the current what? Year. Statement of financial position is also called the balance what? Sheet. What this means is that, for instance, you are showing that you paid, let's say, 1 million naira as what? Rent for a particular year. And now, investigation has showed that out of the 1 million, 200,000 is what? Prepaid expense. I told you, at the end of the year, prepaid expense is what? Deducted from the expense item. So it means that you're going to take out 200,000 from the 1 million. So you charge 800,000 to the profit and what? Loss account. Now, if you have paid your landlord 1 million naira instead of 800,000, it means that the landlord is owing you 200,000. And remember, debtors are those owing the business. So technically, the landlord is owing the business. So prepaid expense at the end of a current year is shown as a current asset in the balance sheet, because technically that amount paid in advance, okay, makes the person to whom the money is paid to a debtor to the what? Business. Now let's look at this illustration. We say, for instance, a payment for insurance in the current year amounting to what? 125,000. And prepaid insurance reported in the previous year is what? 5,000. While prepayment at the end of the current year is what? 9,500. So remember, I said prepaid expense at the beginning of the year is what? Added. The one at the end of the year is what? Deducted. The one at the end of the year, after deducting it, is also seen as what? As a current asset. So it appears in the balance sheet. Now look at it. This is the insurance account. This is the prepaid insurance at the beginning of the year, 5,000. This is the cash paid for insurance, 125,000. So it means we are adding a prepaid at the beginning of the year to the cash paid, and now prepaid insurance at the end of the year we're deducting it 9,500. So 125,000 plus what? 5,000 is what? 130,000. If you minus 95 from 130,000, you have 120,500. This is what you're taking to what? Your profit and loss account. You can see it's a total expense, insurance, 120,500. Now this 95, which is the prepaid expense at the end of the what? Current year, is now transferred to your balance sheet as a current asset. Look at it here. Current asset, you have prepaid insurance, 9,500. Now, prepaid incomes. Prepaid incomes are what? Incomes not yet earned for the period, but payment has been what? Received. You've not yet done a job, so you have not earned the money for that job, but you have received the cash for the job. That's called prepaid income. Now, if you have rental income received from tenants for 2 years, okay, it is assumed that the money has been received for a period which is not yet due for receipt. So if you have received an income, okay, from a job that you are yet to do, we say that that income has been what? Prepaid. So anytime you have not earned an income but you have received the cash, we refer to it as what? Prepaid incomes. Now, in the same vein, prepaid incomes, okay, prepaid incomes can have at the beginning of the year, which is same as at the end of the previous year. Okay, it's the same thing. You add prepaid income at the what? Beginning of the year to the amount treated as earned for the current year of what? Reporting. For instance, the rental income in the current year is 150,000, and they said the prepaid rental income reported in the previous year is what? 9,000. I said you add prepaid income at the beginning of the year, so you add 9,000 to 150,000, and then that means what? If you're not having any prepaid income at the end of the year, you're reporting 159,000 to the what? Income statement. We're saying that what? A cash receipt for rental income in the current year amounting to 150,000, and a prepaid rental income reported in the previous year as 9,000. So if you reported something in the previous year, it becomes the one at the beginning of the year. And I said prepaid income at the beginning of the year is added to the amount charged for or deemed to be earned for the year. So look at it here. This is the rental income. We have prepaid rental income at the beginning of the year. This is 9,000. Cash received for rental income 150,000. So 150,000 plus 9, that's 159,000. That's what you're taking to profit and loss account as an income. So we have other income here. Rental income 159,000. Now you can as well have prepaid income at the end of a particular year. So prepaid income at the end of a particular year is adjusted by what? Subtracting the value from the current year income recognized. Remember, at the beginning of the year we added, but at the end of the year we subtract. Now that amount subtracted at the end of the year is reported in the balance sheet as a current liability. Why? Because if you have received an amount of money for a job you have not done, you are owing the person that paid you. So it makes what? The business to have what? A creditor that is yet to be what? Paid. So when you have prepaid income at the end of the period, it is a current liability. When you have prepaid expenses at the end of the period, it is a current what? Asset. Now, this is also another example. Let's take the same example. Let's adjust for it. Now, let's say a cash receipt for the rental income in the current year is what? 150,000. And the prepaid rental income reported in the previous year is 9,000. And the prepaid income identified for the current year is what? 15,000. Okay? So now, remember I said prepayment at the beginning of the year is what? Added. At the beginning of the year is added. At the end of the year is what? Deducted. So here we have prepaid rental income at the beginning of the year, 9,000. Cash received for rental income, 150,000. Prepaid rental at the end of the year, we're deducting 15,000. So 150,000 plus 9,000 is 159,000. Minus 15,000, we have profit and loss account, 144,000. So we have here other income, that's rental income, 144,000. The amount of prepaid income at the end of the year is reported as what? Current liability as prepaid rental income, 15,000. So prepaid income at the end of the year is a liability. Prepaid expense at the end of the year is a what? It's an asset. You have to be able to identify that. Now here is a summary of the what? Adjustment for prepayment in the final account. Final account here we're talking about what? Trading profit and loss account, or the comprehensive income statement, and the balance sheet or the statement of financial position. So let's go for prepayment. Let's say prepaid expense. Now this is a summary. At the end of the year, add to the amount paid for the year. Sorry, at the beginning of the year, that start of the year, add to the amount paid what? For the year. Then at the end of the year, deduct from the amount paid for the what? Year. Okay? Now, what's the balance sheet effect for prepaid expense? Current what? Asset. And it must be for the one at the end of the year. The next one is what? Prepaid incomes. At the start of the year, deduct from, so income here at the start of the year, you add to the amount received for the year, and at the end of the year, you deduct from the amount received for the year. So the effect is what? Current liabilities. So in summary, your prepaid expense at the end of the year has a balance sheet effect to the current asset. Your prepaid income at the end of the year has a balance sheet effect to the what? Current liabilities. At the start of the year, prepaid expense, you add the amount paid for the year. At the end of the year, you will deduct from the amount paid for the year. Incomes, add amount received for the year at the start of the year. Then at the end of the year, deduct from the amount received for the what? Year. So this prepayment at the beginning or at the end, we find them more in an incomplete record setting. Okay, but in a complete record setting, you have more of what? End of the year adjustments. Now, this is an illustration. There's a question. Well, this is a question we used in our previous class without adjustment. So you can just go to previous class without adjustment and familiarize yourself with it. We just, added one or two things. Okay, so we've done a class on trading profit and loss account and balance sheet without adjustment. So now we're adding adjustment to the question, but because this class is for prepayment, so we are only adding prepayment adjustment. So in the next class, which will be for accruals, we add accrual adjustment. Okay, so let's do prepayment adjustment in this class. So this is the question. From the following, you are to prepare trading profit and loss account and balance sheet as at 31st December 2018. So here are the what questions. We have sales, land, purchases, returns inward, carriage inward, rent, warehouse, motor vehicle, equipment, bank loan, bank overdraft, salaries and wages, capital, returns outward, prepaid discount received as at 31st December 2017. And we are preparing for 2018. That means this is what? As at the beginning. Okay, discount received, discount allowed, opening stock, debtors, cash, goodwill, closing stock. They will now have additional information. Now they said prepaid rent as at 31st December 2018 is 25,000. Additional information 2. Prepaid warehouse expense 31st December 2018 is 15,000. Additional information 3. Prepaid discount received 31st December 2018 is what? 15,000. So we're going to prepare the what? Trading profit and loss account and balance sheet, taking into consideration the adjustment, the end of year adjustment, okay, given to us in the question. So let's go. We already know how to prepare our trading profit and loss account. We've done that in the previous class, so we're going to be doing it again. Okay, so now this is what our trading profit and loss account for the year ended 31st December 2018. I already told you your trading profit and loss account is a function of your what? Your turnover, your cost of goods sold, your other income, and your total expense. Okay, so the first one is your trading account, which will help us to get our gross profit, and we have turnover less cost of goods sold. Our turnover is in note 1, which is 405,000. So how did we get the 405,000? We go to note 1 here. Note 1, we see sales according to the question to be 455,000. Yeah, that's the sales. So we have return inward to be 50,000. Yeah, that's returns inward. So if you say sales minus returns inward, you have 405. That's how we got the 405. The next one says cost of goods sold to be 278,000. Note 2 will tell us how we got it 278,000. So we have cost of goods sold note 2. I already explained how to get this in the previous class. Okay, so we have opening stock 30,000, purchases 240,000, carriage inwards 35,000, return outward 20,000. Okay, so when you add this and you minus this, you have this. Why am I taking out return outward? You bought goods and you return part of it. That will reduce what you've purchased. Okay, Opening stock is the stock you have before you bought more. So when you buy more, it will increase what you have in store. Carriage in was the amount you spend to bring the product to the place you're selling them. So you spend more. That's why you're adding opening stock to purchases and carriage inward before deducting your returns outward. Okay? So this here, you can call it cost of goods available for sales. So when you take out your closing stock of 7,000, you have 278,000. That's how you got this. So our gross profit is a function of turnover minus what? Cost of goods sold. That will give us 127,000. The next one is other income. That's note what? 3. So first of all, we look, is there any additional information to other income? Yes. Look at adjustment 3. Prepaid discount received 31st December 2018 is 15,000. Okay, and if you come to the question, we have discount received to be what? 45,000. Then we have another one, prepaid discount received 31st December 2017. Remember, the end of a particular year is the beginning of the following year. So the end of 2017 is the beginning of 2018. So prepaid discount received for 2017 is prepaid at the beginning of 2018. And I told you, prepayment at the beginning, you what? Add. At the end, you what? You deduct. So here, these are our discount received. The amount is 45,000. We have a prepayment at the beginning of the year that was supposed to add, which is 10,000. And then we have at the end of the year, which is 15,000, so we deduct. So 45,000 plus 10,000 minus 15,000 give us what? 40,000. So our other income here is 40,000. So if you add other income to what? The gross profit, you have 167,000. So take out your total expense. What are your total expense? We have what's the first one here? We have warehouse expense, 35,000. Is there an additional information to warehouse expense? Yes. Okay, look, they said prepaid warehouse expense as at 31st December 2018 is what? 15,000. And I told you prepayment at the end of the year, you deduct. So where's our warehouse note? Our warehouse note, look at it here, warehouse expense is 35,000. Okay, minus prepaid expense at the end of the year, which is 15,000. What do you have? 20,000. What's the next expense? The rent. We have rent. Rent is 58,000. Is there an additional information? Yes. They say rent, prepaid rent as at 31st December 2018 is 25,000. Remember, prepaid expense at the end of the year is deducted. So we have rent 58,000 minus 25,000, which is 33,000. The next one is salaries and wages. Is there any adjustment? Adjustment? No. So we just pick it. Salaries and wages 22,000. The next one is discount what? Allowed. No adjustment. We just pick it. So when you add 33,000, 20,000, 22,000, you have what? 100,000. So total expense here is what? 100,000. So if you say gross income of 167 minus total expense of 100,000, you have 67,000 as your what? As your net profit. So that's your trading profit and loss account. The next one is your balance sheet. This is statement of financial positions at 31st December 2018, also called your balance sheet. Your balance sheet shows your what? Assets and your liabilities. In your balance sheet, you have total assets, which is what? Non-current assets and current assets and other assets. So in this question, what are the non-current asset items? So we have note 5. So we have note 5 here. We have land and building is in the question, 240,000. Motor vehicle is in the question, 325. Office equipment is in the question, 250. Let's show you here. As you can see, this is the land, 240. Okay, this is the motor vehicle, 325. Okay, then we have office equipment, 250. So if you add all together, you have 815,000. Okay, so that's it. Okay, so basically if you add all the assets together, you have your what? Your other assets in the question, you have your current asset in the question, but don't forget your prepaid expense is a current what? Asset. So that's why in the current asset here, you have prepaid warehouse expense and prepaid rent, the one that you have what adjusted for. So that will increase your what current asset item. And then in the current liability, you have prepaid discount receipt, the one you have adjusted for. So at the end, when you bring your long-term liabilities, okay, which is your what? Your bank loan is in the question. Short-term liabilities, okay, that's what we have there. When you add all your what? What do you call it now? Your prepaid discount receipt and your bank overdraft, you have what? 25,000. Now then the owner's equity. You can see the owner's equity, that's capital. Okay, and then you have the profit. That's it there. So if you add long-term, short-term with your owner's equity, you have 972,000, which is total liabilities. The same thing as your what? Total asset, 972,000. That has what? Balanced. So basically, is the question we solved in the previous class, but we just added a little bit twist to it so that we can accommodate for adjustments and basically the prepayments. Okay, so you can go through it. If you have questions, you can reach me on 081365063356 or send me an email, jeremiah.doso@gmail.com. Drop questions in the comment section. I'll be there to reply you with the right answers. Join me in the next class for accrued adjustments or adjustment for accruals. Thank you.